Crypto products and NFTs are unregulated and can be highly risky. There may be no regulatory recourse for any loss from such transactions.
Hello and welcome to ETMarkets Crypto Q&A. I'm Aloni Bhatt. Today we have Parth Chaturvedi, lead crypto ecosystem at CoinSwitch Kuber, who will respond to all your questions. Now, Parth is a crypto native since 2018, and before his role at CoinSwitch, he was a management associate at FalconX, which is a digital asset trading platform headquartered in the US.
This is Parth Chaturvedi. I'm the lead for the crypto ecosystem here at CoinSwitch Kuber. We've been doing these set of educational videos, or AMAs as they call them, picking up like various topics in the crypto and DeFi world, and discussing them in detail. Today, the topic of discussion is DeFi, which is a short form for decentralized finance, and we will be taking ahead this topic in detail. So let's begin with the simple definition of what is DeFi and how is it different from traditional finance. So just as the word represents, decentralized finance is basically the removal of intermediaries from the financial network. DeFi is possible because of two major underlying tech changes that have happened. One is blockchain technology, which makes the entire process more permissionless and transparent, where anybody can participate on the blockchain, and what are the transactions that they do is clearly recorded on the blockchain. And the second important piece in the underlying tech is smart contracts, which are self-executing contracts based on when certain conditions are met. So decentralized finance, basically, there is no single entity or person that controls, the money supply or resources. It basically removes intermediaries like banks and, exchanges or other financial institutions, and gives greater control over, what you do with the money plus the transactions that happen. It basically is a radical concept, and it changes the way we transact and use financial instruments. These transactions, they will run on smart contracts, which are, as I mentioned, self-executable and run on automated code. No one can change the rules set in these. And basically, this auto execution is a great way to bring about equality in terms of how the protocol sees its users. So what makes DeFi unique? At this juncture, I would like to draw your attention to how banking works, and how it is a very sort of a gated system, where basically once you qualify for participating in that network, only then you can have access to basic financial exposure. And that is where DeFi is unique. It basically simplifies the onboarding process. There is no restriction on who can participate on the network. It basically cuts all the complexities that are involved. So imagine opening a bank account. You need paperwork, you need to do follow up with people, provide them with your ID and everything. In decentralized finance, all of this is taken care of using your wallet addresses. So this removal of intermediaries, it just makes transaction speeds more efficient. It reduces costs overall, and is a very efficient system that works in a trustless way. So again, major draw for people away from the banking system is because the banking system is a closed financial system. Even though here in India we know that the Jan Dhan Yojana has resulted in a lot of people having bank accounts now, but globally, if you see, the amount of people who have bank accounts is still very low in most of the emerging economies of the world. And for them, DeFi becomes a source of tapping into global capital. So the next question that I have is some of the features that make DeFi unique. So as I mentioned, DeFi is permissionless. It's a permissionless financial ecosystem. It ensures that anyone, anywhere in the world can access it and will be served by the virtual platform without any restrictions or centralized permissions of sorts. The major technical highlight that you must be aware of about when considering DeFi is the automation using smart contracts. Smart contracts make DeFi products and services secure and self-executing. And unlike in traditional finance, you need not look over the validity of every transaction, or figure out like what was, if there has been a fund reversal or there has been issue at some endpoint failure. All of these partial payments, fund backs, refunds, everything is automated into the smart contract, and you don't really have to worry about these things. This entire process, smart contracts and blockchain, make DeFi very transparent and auditable. Every DeFi system has like these underlying smart contracts that you can actually go and review, and in real time see how they are handling the different funds. And again, one of the unique qualities of DeFi is that it is trustless, meaning that it will not depend on one particular participant or financial institution. So the trust factor is achieved through consensus, code, cryptography, and rules that govern that particular blockchain. So people who have been following the space might have heard about how DeFi has evolved over the years, and they talk about DeFi 1.0 and DeFi 2.0 and what are the differences around that. So I would just take a moment back. I would say that DeFi in itself basically came into prominence just after the pandemic. DeFi existed before that, but was very fairly to the fringe. And initially, I would say even at the present, a majority of DeFi is built on top of the Ethereum network. Ethereum, because it has one of the most robust networks in place. It has audited smart contracts, and it just makes building applications on top of it easier. That is where DeFi 1.0 was originally conceived and built on. It is still very much around. DeFi 1.0, in fact, after the recent crashes that we have seen in the market, it has come out even stronger than before. At a very broad level, you can think of three main decentralized finance protocols, as you might call them. So first is decentralized exchanges, also called DEXs. Then there are basically automated market makers that bring about some kind of parity between different assets that you want to swap, like prime example being Uniswap. And there are decentralized lenders, which basically provide you with instead of going to a bank or a centralized platform, which we have seen has not been great in the recent past, where Celsius, BlockFi, even in the India example, Vault, these are all examples of centralized crypto lending platforms. They have not done very well. Whereas decentralized lending platforms like Aave or Maker, they have performed extremely well even in times of stress. And the third, decentralized finance piece is around liquidity pools, which basically allow you to create pools of liquidity and be rewarded for providing that liquidity into those pools. Prime example being Curve for one. That's more or less how DeFi 1.0 has existed. DeFi 2.0 is a set of protocol level changes made to the existing DeFi 1.0 solution, and basically improving their throughput and possible build more complex structures on top of DeFi 1.0. So I can explain this in a little more detail in terms of how it improves DeFi 1.0. It comes as the second generation of existing DeFi protocols, and the way that it is differentiated is that it reintroduces the importance of smart contracts, basically building in insurance within these protocols, so it can actually offset investor losses via self-actuating insurances. DeFi 2.0 also brings with it better security audits to the smart contracts, making them work better because they are immutable in nature. A major highlight of DeFi 2.0 is that it has becoming more cross-chain and multi-chain. This way, it becomes possible for users to transfer assets across different blockchains. And this is where it is important for younger chains, like where there is less liquidity, to be able to interact with an asset on Ethereum, which has like much more liquidity compared to that. And this cross chain, and there are definitely like risks that come with it because of the cross chain movements. But in general, interoperability between blockchains has increased because of DeFi 2.0. And like another key differentiation in DeFi 2.0 is that it is designed to work, better with traditional finance via oracles and APIs. So hopefully it is going to result in higher degree of adoption. So then the clear-cut answer, like for people to invest in, should they be investing in DeFi 1.0 or 2.0? Overall, DeFi as a sector is fairly young and has seen like a lot of challenges, in the sense that there have been hacks, there have been some smart contract bug that has resulted in draining of your money. There have been rug pulls where false protocols get a lot of liquidity and then dump the tokens later on to retail users. So there is a lot to understand before investing in DeFi 1 or 2.0. DeFi 1.0 has a major strength in the sense that it has been around for longer. It is a much more established protocol, and it has also been seeing a lot of institutional interest. So prime example that I want to give here is Aave, which is like a lending protocol. What it does is that it creates these liquidity pools from where people can borrow, or they can also deposit assets. They have launched an institutional offering called Aave Arc, where basically the liquidity providers and the people who take liquidity from those pools are all going to be KYC and AML approved. So in that sense, DeFi 1.0 is already becoming more real world than DeFi 2.0. Also, in the recent downturn of events where I mentioned, like centralized lending platforms are the ones which are facing major issues, solvency risks. Whereas in the decentralized lending platforms, there was auto execution that happened, and they kept on running like clockwork. So whenever there was a margin call, collateral was sold off, positions were closed. Unlike in the traditional sense or in centralized platforms where there are, each user can get unique benefits from that particular lender. So several DeFi 1.0 solutions like Curve, MakerDAO, Yearn Finance, they continue to be used a lot, and they continue to be primary choice for investors as well. They have like native tokens, and again, like while making individual token investments, you must understand the tokenomics behind it. How will that token accrue more value in the long run? And that is going to differ for each different token. So again, like that research is pretty important. DeFi 1.0, another major point is that they will continue to play an important role in DeFi 2.0 projects because they are mostly built on top of DeFi 1.0. So there is no direct answer to how you should look at investing in DeFi 2.0 because it is still fairly young, and there have been like some tokens which have like seen crazy amounts of growth. The primary example being Olympus DAO or the OM token. So on the flip side, you've also seen like the entire Terra Luna debacle. It sort of happened because of a DeFi lending protocol on the Terra blockchain called Anchor. Again, so those kind of risks are also need to be kept in mind before investing in DeFi tokens. Another question that we are getting from users is that it is said that DeFi reduces the cost of transactions. Can you give an example? So most definitely, yes, it does reduce our transaction costs, primarily because these intermediaries are removed. You don't have to go through several check processes again and again, versus smart contracts that auto execute basis on when certain parameters are met. A transaction on DeFi does have a cost that you have to pay the platform a certain amount of network fees. So basically, whenever you run a smart contract on Ethereum, you have to pay ETH to run that smart contract. So that basically is a fee that you end up paying. But just to give you an example of how that fee varies, it varies depending on the usage of the network. So let's say if there are a lot of transactions going through, then probably the fees will be higher, versus when like the network is relatively free, then you can expect like lower prices. So a great example that like is often quoted is in April 2020, a user transferred about 1.1 billion in Bitcoin, which was around like almost more than a million Bitcoin were transferred for a fee of only uh, some cents. So it was like, I think around 68 cents. Similar transaction and through like, traditional financial channels would have cost thousands of dollars, if not anything less. Primary reason is because it is so secure that even for such large amounts, the network trusts the participants and executes it without any further checks in place. Another concept that we've seen related to DeFi is gamify, where it's growing popularly and it's like taken the market by surprise. Uh, I would like to take a moment here to explain the concept of gamify and how it works. So gamify is a sort of convergence of video gaming, blockchain technology, and DeFi, which allows these gamers to earn crypto assets while owning and trading different virtual elements in the game. So play to earn, as you might have heard, is a popular concept. That is like a version of gamify. Gamify incentivizes gamers for their effort and time spent while playing and winning games. It takes video gaming from walled off data networks onto the blockchain, enabling gamers to have verifiable ownership of virtual assets in the form of NFTs that can be bought while playing the games. So why this is important is that if you've been playing games for a while, you would notice that it's a complete black box in terms of how pricing or any transactions related to in-game assets is done. So let's say if you want to buy a sword, it is decided by the game how much that cost, what is going to be the cost for that particular sword, and you cannot really trade that sword with other users, or even if you can, the process is fairly opaque. What gamify is trying to do is taking this entire transaction and moving it to a blockchain so that you get extremely transparent real-time updates in terms of how the assets are being priced. Another question related to gamify is that like most experts have the opinion that gamify will drive mainstream crypto adoption, and this has to you have to look at this in terms of the gaining importance of games in general. Gaming as an industry is much bigger than movies, audio, and like video content combined. And that's the amount of interest that gaming as an industry is receiving. So, and it touches like a billion plus people. So definitely, like gaming can be like the catalyst of sorts that brings about like mainstream crypto adoption. From the perspective of crypto market, gamify is set to drive mainstream adoption and like drive further growth of this asset class. Compared to DeFi and other blockchain protocols, people will find gamify much more interesting, and because it is embedded in the games, you get to learn more and explore more about the different elements of crypto assets. It will probably like lead to a rapid learning curve of sorts where masses try to understand what these underlying assets are, and like then further drive mass adoption. If you just look at like the investment numbers, so gamify is the preferred choice for investors as well. In 2021, blockchain and NFT gaming companies received $3.2 billion in investment, and they are experiencing like a continuing influx of capital. So even in the current downturn, what we have seen is that VC money has slowed down coming into the digital asset space, but those numbers are still going extremely strong for gaming related companies or gaming related startups. Like in other crypto verticals, DeFi too has some underlying risks. I would like take a moment to state some of those risks and basically give you more details around that. So DeFi, as I mentioned in the beginning, it's a very new concept, and because of its novelty and fairly new nature, it has seen a lot of frauds, hacks, and rug pulls. A metric that is used to see DeFi growth is TVL, or total value logged in these DeFi protocols. That had crossed 250 billion earlier this year, and it is now like about like close to around 100 billion. But if we see the growth that it has seen, it had grown by over 10 times in the year 2021. The concept of DeFi is revolutionary, and that is why it is gaining so much, attention and capital and money from users. But the risks associated are again like fairly important to assess and understand. These could be, classified as the following. There could be intrinsic DeFi protocol risks. So DeFi eliminates, counterparty risks with its smart programmable, smart contract language. However, the risk can arise from default behavior of the smart contract protocol itself. These are referred to as smart contract bugs and have resulted in major, hacks in the recent past. Then, beyond these intrinsic risks, there are also exogenous protocol risks. These refer to the ones that arise out of a result of exploitation of the vulnerabilities in the DeFi protocol. Among other things, like these bugs that I mentioned, they can result in exploitation of flash loans, or there's another concept of oracles. So basically, how smart contract functions is that it auto executes after it gets some input. This input is provided by oracles, which are connected to, let's say, a price data point or a temperature data point or anything else. So these oracles can also be manipulated, resulting in an exogenous risk to your DeFi platform. Then there's a risk of governance. So one of the unique characteristics of DeFi ecosystem is that it is like, decentralized and run like a decentralized organization. But governance votes and proposals can alter the characteristics of these DeFi platforms. For instance, a person holding the maximum number of tokens for one particular DeFi protocol can influence the outcome of how governance is set forth moving forward. Related to governance risks, there are also blockchain specific risks. At present, like most DeFi platforms, as I mentioned, are built on Ethereum, which faces like issues like scalability and high transaction costs. This is not to say that like there are other chains that are gaining a lot of TVL, or total value logged, but they also face like similar challenges around scaling and transaction costs. Plus, a great difference between Ethereum and other chains is that Ethereum is like I would say fairly decentralized, versus a lot of these new blockchains are concentrated in terms of like who are the token holders. And finally, we have to look at market risks. So market risks are associated with the high volatility that crypto assets have in general, and they bring on like an added layer of risks to DeFi. For example, a deep correction in the price of crypto assets can lead to massive outflows from DeFi liquidity pools, creating imbalances and slippages. Example primarily that we can quote that has happened in the recent past is the Terra Luna crash. It was a market risk. We saw like heavy, massive selling of both USD and Luna that led to the crash of prices in both the tokens. I mentioned Anchor protocol in the beginning. So what was happening? In Anchor, you could have deposited the stablecoin USD Terra and earned really high interest rates. But this was fundamentally flawed because they were, driving up those high interest rates by using their own treasury, using risky DeFi strategies. And once the price, started to depeg from the dollar, there was a run on the bank, and people wanted to remove all their Terra from the Anchor protocol, resulting in a broader market sell-off. So, as I mentioned, like there are quite a lot of risks while you are, evaluating, investing, or participating in DeFi. How should one go about, managing these risks? So, DeFi is an emerging marketplace, and there are no established risk management practices at present that you can refer to. However, monitoring DeFi market trends and risks can help you reduce the impact on your DeFi investment portfolio. For example, monitoring the share and composition of liquidity pools gives you a lot of information. If you see how liquidity is flowing in and out of pools, what is the slippage, what is the effect of volatility, that again, like you can get like a sense of how well managed that DeFi protocol is. And based on top of that, like you have to like see the governance proposals that are coming to place. Are the governance proposals more are they catered towards the token holders, or are they catered towards the founders and the investors? You can easily access different metrics around these DeFi protocols on the particular websites known as DeFi Llama. I think is the primary source where you have to go and check. You can get like a lot of details as to how different DeFi protocols are functioning. Here you can also find out audit reports to check the transparency and governance proposals of different DeFi protocols. This should sort of help you in understanding and navigating the space. But in general, consider DeFi as like a sub sector within crypto, which is more riskier than the rest of crypto, because it is a fairly new concept and is still trying to iron out any sort of problems that it faces. You should consider diversifying within DeFi as well. So like, do not put all your money in one particular protocol or one particular lending pool. Try to diversify as much as possible. That just like reduces your concentration risk. That's about it for today's edition. Thank you.
Well, that's it from us. Hope this was all informative. Now do write into us at ETMarkets Crypto Corner with all your thoughts and questions. From all of us, goodbye.
Crypto products and NFTs are unregulated and can be highly risky. There may be no regulatory recourse for any loss from such transactions.